The Santa rally trying to make an early appearance this year, but the big question, can it hold? Options market says yes, with calls on the rise and some influential market voices also sounding bullish on U.S. equities. All this despite some very real geopolitical and economic headwinds on our radar. Our next guest, he's been constructive most of the year, but where are the pockets that he's looking at and how things stand today? For that, we want to bring in Max Kettner. He's HSBC Chief Multi-Asset Strategist. Max, it's good to see you. So we got this inflation print this morning. We're obviously seeing a reaction here in the pre-market ahead of the open. Does this further prove that maybe there is more upside before the end of the year?
Oh, yes, absolutely. And thanks for having me. Yes, I do think so, right? I think this is sort of not the all clear for a year-end rally, right? There may be some things still happening, fine. But I think a December rate hike is pretty much off the table for the Fed, right? And there is no real reason for the Fed to sound particularly overly hawkish now, right? So I think, when we look at today, it's as Goldilocks as it can possibly get, right? Like it feels much more a bit like, what do you actually want to sell now, right? Like if you do asset allocation like myself, it's a bit like, what do we want to be underweight, right? It feels a bit more like, okay, in terms of the preferences, I still like the US, I still like tech, I still like growth. Absolutely, yes. But the biggest risk for us was really a continued overheating of the US economy and an uptick in inflation. And that's just not happening. It's the opposite. And that's really, really good.
So if today's CPI print is the first sign of a true move towards the inflation target that the Fed has put out there and a real step in making sure that we can eventually get towards a cut at some point, then does that signal to you for the markets rally on? And if so, where? And are we erasing some of the declines that we had seen in full that started late summer?
Oh, yes, I think so. I think that's easily possible over the next couple of months because when we think about the next couple of months, or let's say the next sort of until the first half of next year, look, what we're seeing is an environment where inflation is probably going to dip a bit further, right? So you don't have to be wildly optimistic to say you can see core PCE inflations, like core inflation in the US, below 3% by sort of April, May next year, right? And at the same time, people aren't really particularly optimistic on growth either, right? If we look at, for example, things like earnings growth forecasts for the S&P, consensus earnings growth forecasts, then, the consensus is now positioned for quite a dramatic decline in the fourth quarter and even a decline in the first quarter on a sequential basis, right? So consensus is actually saying that earnings for the S&P are going to drop now from this Q3 reporting season to Q4 by around $3, which would be around, a bit more than 6% quarter over quarter drop. And even in Q1, consensus is saying we're not going to be back to the earnings where we just have seen in Q3. So expectations, not only on the inflation and the rate side are important, but expectations on the earnings side, equally so, are really, really quite pessimistic for the near term. And that's great, right? It allows for continued sort of positive surprises, such as we've seen on inflation, but also positive surprises on the earnings and the growth side. Both of that means Goldilocks. It means overweight US stocks. It means overweight tech. It means overweight consumer discretionary, right? It's an environment where really the growth factor should continue to outperform.
Max, as I think could both agree on, nothing goes up in a straight line. What do you think could blow up this FOMO trade?
Yeah, look, I guess it's one of the questions that we get the most, right? Because people don't like being overly optimistic, such as ourselves this year. But I think the biggest risk is not actually the recession risk, because let's face it, when we look at particularly aggregate sentiment from the largest asset managers, right? So how the large asset managers worldwide are thinking. On aggregate, they're underweight equities, they're underweight high yield credit, they're overweight sovereign bonds. So they are positioned for some sort of really material slowdown in growth. So to me, that's not the risk. The risk is that we're going to start to see something, something similar to the third quarter, where growth is going into overheating territory. Why is that so dangerous? Because it means the long end of the yield curve spikes again, the dollar spikes again, and those two things, right? Real rates up, the long end up, long end volatility in rates particularly up, and the dollar stronger. No asset class likes that, right? The big risk is on that because it's the overheating that really then makes all the asset classes across the board sell off.
Max Kettner, who is the Chief Multi-Asset Strategist over at HSBC Global. Thank you so much for joining us here this morning. Appreciate it, Max.